In simple terms, a mortgage is an amount of money that you borrow from a financial institution. You borrow the money over a longer period of time to enable you to purchase a property. The way that you'll be able to work out how much you'll be able to afford and be able to borrow is we'd invite you into one of our branches and sit you down with one of our qualified mortgage advisors. We would then take information from you about your income and your outgoings, and then we would then be able to give you an indication of how much you'll be able to borrow. After we've done your initial assessment in terms of how much you're able to borrow, we would then take from you your details of your income and your outgoings in the form of payslips, or if you're a self-employed accounts, also things like your bank statements we would take from you. And then once we've got the fully completed application form, we'd run a credit check to check your creditworthiness, and then we'd pass you over to our underwriters who would deal with the rest of the application. So there's various different ways of purchasing a property. So for example, with respect to a deposit, if you bought via the shared ownership scheme, which is very popular, you would need 5% of a reduced amount of the overall property purchase price. So for example, if you were buying at 50% of an overall purchase price, you would only need 5% of the 50% you're borrowing. Secondly, if it was via the Help to Buy government-backed scheme, you would need 5% of the overall purchase price, so that potentially is a higher figure. But also if it was on the open market, so you're just buying on your own without any government initiatives, then the minimum deposit you need is 5% of the overall purchase price as well. So firstly, the most common way of taking a mortgage is what's called a capital and interest mortgage, whereby you borrow an amount of money over the prescribed term, and then over the term of the mortgage you pay that mortgage back with the monthly repayments. So at the end of the term, the mortgage is guaranteed to be gone. The other way is what's called interest only, where you have the same term of the mortgage and you pay the interest each month on that loan, and at the end of the term we'll politely ask for all of our money back, please, so you haven't reduced the capital at all. There's lots of ways you can boost your chance of getting a mortgage, and you can really look after your creditworthiness, and our mortgage advisors will be able to check on that and help you with that. You can maintain your bank statements so they look healthy and showing the affordability that we can actually see that you can afford a monthly commitment like a mortgage. Also having all your documents together, so your pay slips, your P60s and all those documents that we would need to see, and for self-employed to make sure we have all of your accounts available as well so we can assess them. You should get a mortgage with Newbury Building Society because you will genuinely get a personal touch. We do pride ourselves on making sure that you speak to an individual and not a computer. So therefore, if something's slightly out of the ordinary, or there was something in the past that you think actually needs someone to listen to you, we will definitely listen to you. All of our advisors are fully qualified, so therefore we know our subject matter and you will get advice that you can trust.